Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. As usual, or perhaps it's not unusual if you're a first-time watcher, then please click on like for us if you would, but also if you want to receive notification of FANG Friday every week, then click on subscribe as well. Okay, today I'm going to do something a little different. I'm going to take a little walk down memory lane. And in fact, I'm going to walk all the way back to the top of the market before the COVID-19 setback and see how things look. And I'm doing this for I think it's a good reason. This market today is getting quite high. It's outrun its fair market value as we measured, although, of course, as we know, part of that reason is because the investors think that we're going to have a V-shaped recovery in the economy, and things are going to come back to where they were at the in January, February of this year. I doubt that that's going to be the case, and what that means is, therefore, that the risks in the market are getting higher and higher and higher. What I think may well be the case, as happened, as it transpired, in the February-March period of this year, the FANGs actually gave a beautiful sell signal on the market. And we're going to see what the circumstances might be whereby they might do it again. And of course, what we might look for on the bottom, but what we really want to do is look potentially at what happens at a coming market peak. The first stock I'm going to look at is Amazon. And Amazon came right up to its HB3 price and hit there twice. Now, normally when you've had a stock that has had a really nice move, therefore you can expect that you're already going to get some weakness at a major breakpoint. And Microsoft, at least Amazon, certainly delivered that. I want you to notice one thing, by the way. Before that happened, there was a huge gap heading up there, and typically at the end of big moves, you get some of these exuberant gaps, these exuberant moves, which unfortunately are often signals of setbacks as opposed to ongoing strength. The second stock we'll look at back there was Microsoft, and remember, after we had I had identified a lovely breakout over the HB1 price, that's 10 times book value. The stock roared up, didn't quite get to its HB2, missed it by about 2%. But we like to allow about a 2% plus or minus error factor when a stock is approaching one of our major breakpoints, because that allows for the fact that old balance sheets are in the process of being factored in to the current price, and there's always a little slippage there. So that got right up to that point. By the way, of course, let's go and take a look at what happened subsequent to that time. Well, the stock dropped all the way back down to its HB1 and actually went a bit below there, although it bottomed precisely on March the 23rd at 21.75, which I think some of you will remember I had forecast in advance would be the bottom of the stock market. So that was the end of Microsoft. I should go back and take one quick look at the Amazon chart, because I want to show you what subsequently happened there. And look at Amazon, eh? It came right down from its HB3 and right down to its HB2 and stopped perfectly. So that was the bear market for Amazon. Alphabet delivered a different kind of message. Alphabet kind of rolled over, and then it, look at that, see, it broke down and then pulled back. Remember, a typical breakdown pullback in the stock, and then the stock proceeded to plummet to its next break point, its super growth price. And of course, we'll look at what happened subsequent to that time. Well, the stock had a beautiful bounce there, and it's bounced right back to its super growth price, which is 4.5 times book value. Hasn't broken out yet. If we're looking for ongoing strength in the market, it would be nice to see Alphabet actually breaking out and going higher from here. Apple, well, Apple rolled over too, just like Alphabet did. It dropped, and by the way, it had a breakdown, pullback perfectly, and then it proceeded to drop a full break point as well. You'll note that the stock dropped a little bit below there, and by the way, where did it fall? Right down to its fair market value, and that happened to be the bottom of the market on March the 23rd. Hit there precisely and closed at the top of its range, and was then right back over its break point once again, where it has remained more or less safe ever since. Of course, I did alert you, I think, to the fact that there's been a major balance sheet change, but nonetheless, what is important here, you can see the dead bottom at the fair market value. Nonetheless, Apple is coming up against its HB3, which is 16 times book value. I'll have to say, going back in all of history that we've got for Apple, that the stock has never been above there. The stock's progress has been really, really slowing down. I would be very, very surprised if Apple is going to be able to get beyond its HB3 price. So I think it's coming into a potential top. Facebook, another breakdown, and this was a different kind of a breakdown, wasn't it? So here's a company sort of bouncing along its mid-growth price happily as other stocks are beginning to let go. But when Facebook let go, it just plummeted and didn't stop one bit. And of course, the fact that at a breakpoint you often get a breakpoint pullback is no guarantee that that's going to happen with every stock, and it didn't. And indeed, the very fact that Facebook did not have a breakdown pullback suggested that there might have been worse in store. So rather than having a one breakpoint pullback, as we had seen with for instance, Amazon and Alphabet, Facebook actually had a 2 breakpoint decline before it found its bottom 2. Now, going forward from here, what do we see in this stock? Well, from its low, it's had, well, look at, it's had almost a 2-point recovery, and it's now broken out. I would have to say that if I were looking at the stock here, looks to me perfectly good. I'm not terribly happy with the fair market value, although after it had been falling, it's now kind of leveled out. So perhaps investors are getting a little more confident that maybe advertising won't be as badly affected as was initially expected. At any rate, potential for this stock, of course, is the bubble price. However, if the mid-super growth price does not hold, okay, then be very careful, because that will tell us that that's it for the stock. Anyway, so far, so good. NVIDIA, well, NVIDIA actually dropped almost a full breakpoint and then bounced. So it actually did what technically it's supposed to do, hit and bounced. But then it broke, and indeed it had having almost had a full breakpoint bounce before anything even got started, it then had another breakpoint before it actually bottomed on March the 23rd, and has had a nice bounce thus far to the HB2. Although let's update this and see where it is now. Well, it broke out over the HB2 and is carried all the way to the HB3, and the stock is now having some trouble getting through there. We need to watch NVIDIA very carefully to see whether that is it for the stock. Anyway, in terms of looking at the potential for another market setback, we'd have to say NVIDIA has maybe not exactly run out of gas, but it has certainly run out of breakpoint, and I would be a little cautious here, not only towards NVIDIA, but just kind of thinking about the risks in the market as a whole. Finally, we look at Netflix, and Netflix actually is the one company that really hasn't given us much of a market signal whatsoever. Okay, it had a little bit of a breakdown. It never got rose to a target. Never really fell to a target, and has recovered fairly nicely. In fact, Netflix is probably one of the two real COVID-19 stocks, and it has come floating through nicely all the way. Although of late it's had a dickens of a time trying to get through its HB4, and it might not actually make it. Therefore, we observe it, we probably hold it, but nonetheless it is not rendering us any signals. Anyway, why am I showing you all of this? Well, now you know what a potential bear market looks like and can shape up to be when we pull together a sort of a unified group of stocks, which are the FANG stocks. However, your own stocks in your own portfolio exhibit exactly the same kinds of characteristics, and you want to be watching those very, very carefully for signs, and particularly overall signs, that your market is warning you that there are lower prices ahead. So far, when we look at the weight of the evidence of the FANG stocks, I don't see it. And what it seems to be very much the case, that the stocks want to go higher. But I think increasingly the FANG stocks may be the canaries in the coal mine, and therefore we shall be watching them particularly closely for signs that the market is finished. Anyway, this has been Ross Healy for Strategic Analysis Corporation and Senior Portfolio Manager at McNichol and Associates, reminding you that nothing, including investing, and nothing including investing in bear markets, is difficult if you have the right tools. Have a good week. I'll see you next Friday.